video, we're going to discuss a really basic cap table. I want entrepreneurs to understand at a very high level what happens when you take financing. So we're going to discuss dilution, option pool, and I want to introduce you to some terms we're going to go over in the future. So first, let's go ahead and look at our common shares founding stage. We see that our team here consists of two founders who each own 40.5% of the company, which is great. But notice what happens as they take a Series A financing. In L7, they own 62.4% of their company. And in P7, after their Series B round, they own 47.56%. In T7, after their Series C round, they own 39.7%. And as they exit in V7, they own about 41% of their company. Now, I tend to think 30% equity is actually pretty healthy. So in this scenario, this team did pretty good for itself. Now let's jump over to our option pool. What I want you to understand in this video is that you have an option pool, it's set aside. In this example, it's 19%. In a future video, we're going to discuss how we get to that number of 19%. We're going to use our financial model, we're going to use our personnel tab, and we're going to actually construct the option pool. But I just want you to understand that the option pool is the stock option pool, and a stock option gives the holder the right to purchase shares at a certain strike price or exercise price, which is generally relatively low. Now, the idea behind your option pool and your stock options is that when you first get going, you're not going to have a lot of capital to pay salaries. So you're going to really want to incentivize your founding team with these stock options. So perhaps they buy them at 50 cents per share or $1 per share, and they sell them at $12 or $13. So think about your option pool as just a special way to incentivize your founding team. And again, go ahead and look at the dilution that's happening. The amount that they own becomes less and less and less as the company gets financed. Next, let's talk about our preferred shares. Now, why do we have two different types of shares? Our common shares for the founders and our preferred shares for investors. Well, investors are going to want to have a richer share. Preferred shares have different rights, which we can discuss in a future video. But for this example, I just want you to understand that the preferred shares always sit with investors. So in our convertible note scenario, we have a very small convertible note. Here it's a total of 20,000. Typically, you're going to have a convertible note of about $500,000. So in this example, there's no dilution, right? A convertible note is simply a note, a debt instrument. You take the 20,000, in exchange you give a note. No equity is ever issued, so of course you see 0%. Then we do a Series A. Now, you're probably wondering why these seed investors who put in 10,000 aren't getting 10,000 shares, because you probably have noticed in L32, the price per share is $1. So why wouldn't they just get their 10,000 shares? Now, what's going on here is that if you look at H30, there's a 25% discount on this note. So what that means is that these shareholders who put in the $10,000 each get to convert into the Series A at a discount. So in this scenario, the share price is $1, so they literally get 25 cents as the discount. So they are taking that $10,000 investment and converting it at a 25% discount, which yields 13,340 shares, which gives them 0.06% of the company. Now, you have two new Series A investors. They each put in 2.5. Now, why do these investors get 2.5 and a little bit more shares? That's because if you look at L32, you'll see that the price per share is not exactly $1. It's rounding to $1, but it's not exactly $1. It's a little bit less. So they're actually getting a little bit more in their shares. Don't let that confuse you. It's just a minor rounding issue. What you want to understand is that these two Series A holders now own about 21% of the company. So here we see in our convertible note, it's converted over to the Series A. And again, something that may confuse you on the cap table is that you're going to see the Series A total was 5. The pre-money was 19. If you add those together, you should get 24 million, but you get a little bit more because we're actually doing a calculation based on the total amount of shares. So remember there was the oddball shares, the 26,000 somewhat shares that came in from these from the convertible note investors. So that's why that number is not exactly what you would expect it to be. So don't let that confuse you. And before we go over to our Series B, I want to just point out that you may have seen something to the left which says cap amount none. We're not going to use a valuation cap for this scenario, but we will do in a future video something called valuation cap effects. And I'll show you why it's important to understand what a valuation cap is, because when you have a valuation cap, it works similar to a discount on your note, but it actually can have a really, really strong effect on your future Series A investors. So you want to understand, if you're taking a convertible note with a valuation cap, you're going to want to know what actually is going to happen to those future shareholders. And so it's very controversial. We're going to actually have our own specific video just for that topic. So we're going to leave it alone for right now. We're going to skip over to Series B financing. So you start to see the same patterns. More money comes in, more dilution happens. And of course, the share price is increasing, and perhaps another video could be what happens when your share price doesn't increase and you have to do what's called a down round. But for this very simple, basic example, we just want to keep it simple, and we want to assume that this company continues to raise capital, continues to increase their valuation until they have an exit. And so you see here, they exit, and hopefully everyone's very happy with their exit. There's a lot of different scenarios which perhaps we can explore in future videos. In this example, we're saying it was an M&A, so we can assume that this company was acquired. A lot of times when a company is acquired, they have what's called an earnout. Now, an earnout means what you probably think it means. You have to actually earn a lot of the price. So for example, they could say it's a $500 million price, but then a $250 million earnout. So the founding team would have to stay on and actually meet some certain milestones or objectives. So lots of different ways you can exit a company. You also could go public, file an IPO, initial public offering. And that has, of course, some restrictions as well, how the people who hold the shares, how and when they can sell them. So we can probably explore that in a future video. Please leave me your comments and let me know what you think is confusing, what you'd like to hear more about, what you'd like to understand more. Just to summarize, this is a very basic, plain vanilla cap table. I want entrepreneurs to understand how dilution happens. I want entrepreneurs to understand why the option pool is important. I want to introduce some terms that we'll discuss in the future, what the valuation cap means, why it's important to understand, and then again, leave some notes in the comments. Let me know what you want to learn more about, and we'll discuss that in future videos.